Between 2007 and 2009, the world's banking systems and financial markets experienced a downturn that was completely unexpected, and it caused a great deal of stress and discomfort to hardworking citizens. Welcome back to my channel. My name is Reese, and in today's video, I'm talking about the global financial crisis of 2007 to give perspective of why it's so important for you to prepare for unexpected downturns in or of an economy, regardless of the case. During this crisis, banks all around the world experienced huge losses and relied heavily on the government for support to avoid going bankrupt. Millions and millions of people lost their jobs, as most of the major advanced economies of the world experienced and fell into their deepest recessions that they had seen since the Great Depression, which took place in the 1930s. And recovery from this crisis was much slower, as previous and past recessions were not associated with a financial crisis. The reasons as to why this crisis occurred came down to countries, primarily the USA, taking excessive risk in their lending, as they were technically in favorable economies and looking pretty good on their balance sheets. Economic growth was relatively strong and stable, and things like rates of inflation, unemployment, and interest were relatively low, and because of this, house prices grew quickly. In the US particularly, because of this growth in house prices, people started to borrow more than what they probably should have in order to acquire property, whether it be for an investment or a place to actually live and settle down. This was also the case for developers who borrowed large sums of money because it was cheap to borrow. So they would buy large sums of land, and then with that land, they would develop houses ready to be sold at a profit. During this booming time, houses were in demand. It made sense. Buy a block of land that you can build 100 houses on, build them, sell them, make fat stacks. Now you might ask yourself, or you might not, why would a bank let someone borrow or leverage themselves up to their neck? So borrow more money than what they can technically afford to pay for, and borrow more money than what the value of the house actually is. It doesn't really make sense. It seems quite irresponsible. Banks and other lenders were willing to take these risks for a few reasons. Firstly, other banks created competition between each other because it was in their best interest to get as many customers on board as possible, because the more people paying them their weekly, monthly, fortnightly repayments to pay off their house, the more money they would make on interest. One of the main reasons this occurred was because lenders didn't really have any tight regulations that they had to follow when assessing an applicant or a person's application to borrow money, which in turn let them borrow more money than they probably should have, which definitely is a recipe for disaster, especially for people who aren't financially responsible. And I'm not pointing fingers at anyone. It's just unfortunate, like they're not educated, and a bank's telling you, yeah, you can lend like this much money, and it's just a ridiculous amount of money that they probably shouldn't be borrowing. If like anything bad happens, then they're kind of stuffed. And this is technically what was happening, because the lenders didn't care. As long as they could give money to people, it meant that theoretically, as long as they're working, they will pay it back eventually. Otherwise, they'll just take the house, sell it for a profit, because it's booming. Houses are cheap. Well, not cheap, but houses are in demand and people are willing to pay for them, and there's people with money to buy them. And finally, investors realistically thought housing is always going to be in demand. There's always going to be people who want to live in these houses. So therefore, the only way they can go is up, which kind of has been the trend for a lot of locations around the world, particularly in Australia. Melbourne and Sydney's house prices just baffle me how expensive they are. I live in South Australia, and I still believe that house prices are still on the up and up. And they still probably have a little way to grow, because as this place becomes more desirable to live, just like other places around the world, they're generally a relatively good bet. Even if the housing market crashes, if you can hold on to that asset, you're going to make that money back eventually down the line. Theoretically, a house is a physical asset, one of the most expensive assets you can buy as a general person. We're not billionaires who can afford big yachts. I'm going to get depressed thinking about it. It's not the point. Ultimately, they're good investments because regardless of if the stock market crashes or whatever, you still have a house that's just sitting there that at some point someone may want to own again, making it a safe investment. But the point here is that one of the major investors in the real estate market was banks. So here's where things started to go badly. Basically, there was a stagnation point where house prices in the US started to fall because people started going, oh, they're a little bit too expensive. I can no longer buy this. It's out of my reach, even if I borrow it up to my neck. And then on top of that, there were then people who had borrowed up to their neck and started going, oh no, I can't actually afford to pay this back. So here's where the recipe of disaster began. People over leveraged, and there was a lowering demand for the housing because it was too expensive for everyone to get into. It kind of shortened the pools of people who could get into those houses. During the middle of 2006 is where house prices started to peak, particularly in the US. And this is the point where it started to flip as well, because all these developers who had bought all this land and built all these houses, the situation was now, oh, we don't really need these houses anymore. What are we gonna do? They're just gonna sit here and we can't sell them. People aren't buying them. Oh crap. We owe a lot of money to the bank and we can't pay it back. And there's no way that we're going to be able to sell these houses for what we built them for. We're in trouble. And this is where things started to really go south. The financial markets started to get hit around mid-2007 because this is the point where banks started saying to people paying their mortgages or people not paying their mortgages, they said, hey, we're taking huge losses because you're not paying your mortgage. We are going to repossess your house and sell it. And the logic was, we'll sell it for what we bought it for and we'll break even. No problem. And what they actually found was people weren't even willing to pay what they were asking for, which was to break even. People were willing to pay less because they knew they were in a position where if I'm going to buy this house, you're desperate to sell it, no problems, I'm just going to scoop it up for a bargain. And this is where banks started selling houses for less than what they had actually basically lent the money out to the person for, which did two things. It put people on the street, people who were already struggling to make their repayments. You're assuming that they potentially lost their job, they potentially fell into some financial stress. And as these numbers grew, the number of houses on the market that were being sold for less than what they were bought for started to grow as well. You see how this is a recipe for disaster? It's two sets of people or two sets of situations which basically snowball and feed the machine. They continually it's going to get out of hand. Let's keep going. A good example of this is, let's say I bought a house for $500,000, the banks repossessed it and sold it for $300,000. Just because they've sold it for a loss and now I'm out on the street and I don't have anywhere to live, I still owe the bank $200,000. I decided to take that loan out. It is my fault that I couldn't make those repayments. Therefore, I'm in a bit of trouble. And now apply this to millions of people. And also look at the bank, who I don't feel bad for. It's their fault that they did it. But look at the bank who now is out of pocket $200,000 because I'm never going to be able to give them that money. From this, markets around the world, such as in Australia, who wasn't hit as badly as other countries, started to see the same things happening. And this is where it really got out of hand. Basically, when financial institutions like banks started going, shit, we're in trouble, like everything's going south, investors started pulling all their money out of the share market, basically causing panic. And the resultant of this was people who pulled their money out of the share market, they're like, oh, I don't really know what's going to happen, so I'm just going to grab my cash and keep it safe where I can cuddle it. And ultimately it sparked like mass-wide panic, and everything just continually snowballed and continually snowballed. It's just a dumpster fire on a roller coaster just going down. And then ultimately from this, businesses became much less willing to invest, and people or households basically reduced their spending because of uncertainty. So what the resultant was economies basically having no income whatsoever and then falling into recession. Like I said at the start of the video, the deepest recessions they have ever seen since the Great Depression, which is not somewhere that you want to be. It's not a good environment for you to be living in. Coming out of the crisis, one thing that was definitely really good that happened was rules came into place on banks and lending and what they could give to people and how they had to assess their applications. And ultimately, a really robust system came into play where if you don't meet certain qualifications or certain application standards, we're not going to give you money, which is a good thing. That's called responsible lending. That means that the person who may be receiving that money is probably okay to be receiving that money, meaning it's not a bad thing if they receive that money, then they're probably going to be able to afford to repay that loan. As you can see, in a very short window of time, we're talking in less than 2 years, basically the whole world went to shit, and it went to shit for another 2 years, which is basically the recovery time. That is a long time when every single day is a hard day. There's a lot of stress, that's a lot of unhappiness on a lot of people around the world. Now, I just want to throw this out there, and we are currently in our own little crisis of COVID-19. Lots of people are suffering, and it's not financially related, it's medically related. It's a virus that's terrible for humans. Now, the thing that you need to be understanding is I personally watch this space pretty closely, and I truly believe that banks are doing it again. They've eased lending in Australia in particular. I don't know about the rest of the world, but in Australia in particular, they've eased lending, making it easier for me to go and borrow a ridiculous amount of money when I probably shouldn't have access to be able to do that. Why is this a bad thing? I don't know, maybe because in 2007, we saw what the outcome of that is. Food for thought. Let's come back to this video in the future and see if I was right. I'm not going to say anything more about it. Overall, the people who put a plan in place and didn't over leverage themselves and knew where their financial situation was at probably experienced way less suffering during this time than people who obviously weren't as well prepared. This is why I preach so much in my videos about organization, planning, and being aware of your finances and actually managing your money and being active about it. It's so important, not because it's you have to make the most money you can and have to buy nice things, just in general to survive in a way that doesn't stress you out, in a way that makes you go, oh, I don't know how I'm going to put food on the table today. Just planning and organizing is the very first step. It's free to do and it doesn't take that much time. It's the very first step to basically being in a more comfortable financial position. It's food for thought, something to think about, and that's why I wanted to cover the topic in today's video. Overall, I hope you enjoyed it. I hope that it was insightful, and I hope you learned something. If you did, please consider liking and subscribing, and as always, I will see you in the next one.